Welcome to Global Money Talk, brought to you by SamProTV. Greetings to all our viewers from the U.S., Korea, and around the world. We are coming to you live from the floor of the New York Stock Exchange, and I'm your host, Remy Blair. We are coming to you live from the financial capital of America in New York City. And joining me for this morning's market briefing is Tai Wong, independent proprietary trader. Tai, good morning, and thank you so much for joining me.
Good morning again, Remy.
Well, today does mark the beginning of the Federal Reserve's two-day meeting, and of course all eyes are on the rate announcement coming out tomorrow afternoon at 2 p.m. Eastern Time. But let's take a look at the markets this morning as we got the release of retail sales figures, which did top expectations, didn't they?
Yes, the headline retail sales expected to fall after last month's nice performance, actually up a little bit today. Overall, I would say the report wasn't too much off consensus, but it certainly suggested that the American consumer is still in reasonable shape, and there's no need for panic. And based on that, on that piece of data, and the consumer remains strong, which is important because we're a consumer-driven economy.
And I also agree with you, Tai, because it does seem as though Americans are tightening their purse strings, but they are still spending, especially given what we saw in the previous month. But let's take a look at the major U.S. stock averages in New York morning trade. Just past the 11 o'clock hour, we're seeing the Dow Jones Industrial Average up triple digits, or 0.3%, while the Nasdaq Composite Index is up 0.7%. And the S&P 500 is also higher as well, up by nearly 0.5%, straddling the 56-58 level. So we also got other economic data out this morning, Tai, including industrial production as well as capacity utilization. And this week is also a big week for housing figures. So let's take a look at what we saw in industrial production. It was higher by 0.8% in the latest month, and capacity utilization rose 78% last month.
Those are both encouraging numbers, not sort of as the tier 1 numbers, but certainly a tier 2 number. Industrial production jumped, which is a nice help to the economy, and capacity utilization is creeping up, and at 78%, that's not bad at all. I can't remember last time capacity utilization got up really past 80% in recent years, but it's a good trend. It's saying that the engines of the economy are still going, and that's going to factor into what probably what the Fed is thinking now. I do think they see everything, but now they're probably going into discussion. So the data tomorrow probably won't matter, but this morning's data, I think they'll take notice of it. Will it change anybody's minds? It depends. I guess it depends on how good of a persuader Jay Powell is, and we don't quite know where he stands.
It was very interesting, Tai, because coming into today's trading session, there are all eyes on U.S. retail sales, and we know that that's not one of the major data points that investors tend to focus on, but recently, given the importance of economic data, there are a lot of expectations riding on this figure this morning.
Yeah, so the Fed's dual mandate in terms of 2% inflation and maximum employment. Maximum employment depends on a lot of things, and seeing how retail sales go is the confidence of the consumer at the end of the day, and that's really. At least retail sales is actually a third of all the spending that we do. There's actually a personal income and spending, which oddly that comes out I think a little later in the month, oddly doesn't get a lot of attention, but that's actually really important because personal spending includes services, which is the other 2/3 of the spending in this economy, whereas retail sales is 1/3, but it's stuff that you buy that you can hold. So I think historically people have really watched that a little bit more, but personal income and spending is actually probably even more important.
And also, Tai, in addition to the retail sales figure in industrial production, we saw business inventories for the month of July come in better than expectations, up 0.4%. Home builder confidence came in at 41 for the month of September as well. So something to keep in mind as we head into tomorrow's meeting.
The home builders are pretty important. That's probably even a tier 3 sort of set, but new homes drive so much spending. You build a new home, you need the lumber, you need the wiring, you're buying all the appliances. That is a big engine of the economy, whereas sort of existing homes is a little less so, because that's all been built, all the wiring's in there, some of the appliances in there, although a lot of people will probably want to replace them as well. But new home sales and the sentiment of the home builders is really a pretty good leading indicator. Inventories are interesting because sometimes you have too much of a buildup of inventories, then people get concerned, are people buying? But right now, I think that's fine and healthy.
And today's home builder confidence index comes ahead of tomorrow's housing starts and building permits, and of course those are the data points coming out in the morning ahead of the rate decision. But I do want to move out to the rate announcement that's coming out tomorrow. So there have been different opinion pieces out there about whether the Fed should cut by 25 or 50 or even more. But one thing is for certain, that the expectations are high. The Federal Reserve will begin their rate cutting cycle.
Right. But I think they will certainly begin in the rate cutting cycle. If they didn't cut tomorrow for any reason, it's sort of get the women and children off the streets moment. There will be a bloodbath in the markets, and the market will be wondering why. But it's an impossibility. They're going to cut. The question is 25 or 50 basis points. And our media colleague, I should say, Nick Timiraeus at the Wall Street Journal, has put in an updated article yesterday, or actually very early in the morning. He basically reiterated his themes, and he really focused on the people who thought it would be 50 basis points. And one argument he had was, he says, one of the people he quoted said, the Fed is going to have potentially more regrets if they don't go 50 and the economy goes south. Whereas if they went 50, and they can always slow down a little bit. So I think that's Nick's view. Perhaps somebody has whispered to him, on the Fed. It'll be interesting. We'll see it in less than in just over a day. But so I have my view. So I think they're going to go 25 basis points, and here's why. So if we go to graphic 1, so here are the Fed's June 2024 projections. In red, that's what they projected at their June meeting, and then so they do it for GDP, they do it for unemployment, they do it for core PCE inflation, and then the Fed funds rate. So it's really a nice little chart telling you where they stood in June and where they stood in March. So if you look at the Fed funds rate projections near the bottom of the screen, in June they thought most of the governors, or the median, or about the average, thought that rates would be at 5.1% at the end of 2024, which was really basically just one cut. That was a big jump from March, where they thought it would be 4.6%. And the reason for that is core PCE rose 0.5% in January, but 0.3% in February, March, and April, which was the last thing they saw, I think the last report they saw before they did the June projection. So that really scared them, because 3% each month, that's 3.6% a year on core PCE, that's high. So what they did was they moved, because of that, I think they moved the Fed funds rate to 5.1%, 50 basis points higher. So if we can go to graphic 2, what I think is, in the ensuing 3 months after the June meeting, PCE has dropped to, I think, 1/10 one month and 2/10 the other 2 months, which is right where the Fed needs it to be. So I think they're going to, they breathed a sigh of relief. That's why everybody said after subsequent, in July and August that they were comfortable moving rates, and Powell explicitly said so at Jackson Hole. So what I see is, we're in a situation for the Fed where, with the exception of unemployment, which is a couple tenths higher than they thought, we're right back in terms of core PCE rather, where they were in March. So I think the September projections are going to look exactly like the March projections, or very close. And the dot plot, which is this visualization of where the different Fed governors and bank presidents see the interest rates being at the end of 24, 25, and 26 on long term, we're going to be back to March. So I think I see a total of now 75 basis points cuts in 2024. So 4.6 at the end of the year instead of 5.1. I think that's the safest route, really, for the Fed. Gives you optionality, and right now, if you look at the CME Fed Watch tool, they're already at 125 basis points for the end of the year. It's actually, everything's correcting a little bit. I think people are trimming sales, adjusting their positions with 24 hours or so to go. But if you go 50 basis points, immediately the market's going to go. They're going to go 50 in September. It's going to be 50 in November. It's going to be 50 in December. They're going to price in 150 basis points. And I'm not sure that's what the Fed wants. I don't, it's hard to see the Fed doing 150 basis points of easing from now till the end of the year, with the concerns that they still have. I think they feel good about inflation. I don't think they're really convinced. And 150 basis points is a lot. And if there's a little bit of a slower growth in the economy or a little recession, people will forget about that. But if you let that inflation dragon loose again, they'll be talking about you in 50 years.
Yes, I'm sure that would be the case. And, we've talked about this many times on the show, Tai. We're heading into this year. We were expecting rate cuts at least by the September meeting. And here we are on the eve of the September rate decision. We have yet to see a rate cut, but as you mentioned, the economic projections as well as the new dot plot. So tomorrow is going to be very busy for the Fed Reserve, because not only will they conclude their meeting and announce their rate decision, whether it's 25 or 50, we'll have to wait and see. But then we get that press conference from Powell, and then the economic projections, and we'll have to wait and see to understand what that means for Wall Street.
Yes, that press conference is going to be really important, because that's where he spells out the thinking and answers questions. Is it 25 with a dovish directive?
Yes.
Will 25 will do more if we need? I think the market will react the way it stands right now. I think stocks, bonds will react poorly to 25 basis points initially, but if he comes in with a dovish directive, then they'll feel a little bit better, and I think you'll see a little bit of a recovery during the course of the day. But if he goes 50, then you have to say, listen to what he says. Is he going to say, we're going to do 50, and then we will see? I think the first story narrative is easier to sell. So that's why I think you ought to do it. I'm going to stick with 25 basis points, and we'll see if I'm right.
And Tai, of course, this is a presidential election year. The next Federal Reserve meeting after tomorrow will be on November 7th, which is 2 days after the election. So the timing is going to be interesting.
Yes.
But of course, not only, hopefully by November 7th will we know who is going to be in the White House next year, but we get more data points, don't we?
Yes. We'll get November 7th. We should have gotten 2 more employment reports. We'll get a couple more PCE, some more CPI.
Inflation, sure.
And I do think that the Fed will probably, I don't think they will ignore it, but they really, I think, will take politics on a back burner in terms of when they're making their decisions. I think they're good enough for that. I think they realize how important their job is, and they won't let rhetoric sway them. Although I think, as you rightly mentioned, hopefully we will know who's going to be in the White House on November, by the next meeting. But we might not. So, and if we don't, and there's a tremendous amount of turmoil, especially if it looks like it's very close, and we may go into December like we did Bush versus Gore way back in 2000, then does that make them say, if there's a lot of turmoil, do they want to cut and look panicky, or do they want to wait and see how it shakes out? But I think that'll be a discussion for late October, early November, and we'll see how the race shapes out by then.
Absolutely, yeah. And when you think about the timing of the November 7th rate announcement, we have to keep in mind that November 5th, Election Day here in the U.S., falls on a Tuesday, and usually the 2-day meeting ends on a Wednesday. But this year, because of the election, the Federal Reserve rate announcement will be coming on a Thursday, so that's also interesting as well in terms of timing.
It is, and I'm glad you brought that up, because if you're an options trader, and certain options, if you buy over-the-counter options, they expire on certain dates.
Yes.
So you don't want that. You don't want to expire. Your options, your long options in any case, to expire that Wednesday. You want to expire that Thursday. In fact, if you'd be very unhappy if you paid a lot of money for options and they were a day short. So maybe you want to sell the Wednesday and buy the Thursday. Is what sometimes options traders like to do.
Yeah, absolutely, Tai. And speaking of expiration, at the end of this week on Friday, we do have a liquidity event in terms of quadruple witching, the S&P rebalancing as well, and expiration. So that might add to some of the volatility that we see this week on the heels of that rate announcement from the Fed.
You're absolutely right. We haven't had a meeting that was this close where the market really wasn't sure which way we're going to go, and they're nearly evenly split since 2007. That's a better part of 20 years. So this is really, people will really be watching. Is it 25 or 50 instead of trying to read the statement and the report. Well, just read the statement. The minutes won't be out till much later. But read the statement. So the numbers actually going to be important tomorrow. And I'm out be like everybody else, watching the announcement as it comes out at 2 o'clock.
I'm sure we're going to be waiting with bated breath to see what that announcement is like.
Yes.
Well, right now I think it would be a good time to take a look at the movers in terms of leaders and laggards. So in New York morning trade, we are seeing Intel lead the Dow Jones Industrial Average higher, and it's up by nearly 8% this morning. Well,
Intel has had a pretty good week because essentially they were really sort of, sentiment a week ago was really poor. That is Intel going to have to break itself apart? Sentiment was at the bottom, and sometimes sentiment at the bottom, in terms of what Warren Buffett likes to do, is sometimes you buy when there's blood in the streets. And I'm not enough of a semiconductor genius. I thought about it just on price action, and I probably may have missed the boat. But some really good news for Intel was that they got a $3.5 billion deal from the military to do chips for the military. I think it's part of the CHIPS Act. And then they also are splitting out their business, their foundry business, as a wholly owned subsidiary. So I think it's a good business, and it'll be able to see the sort of the light of day a little bit better. And then yesterday it was announced that they're going to make special chips for Amazon. And Amazon, another leader today, looks like they're trying to sort of revive themselves a little bit. They've been accused of being a little heavy and a little stodgy, so it's been good news for Intel after a huge amount of bad news. So does this 8% in a day? That's a lot. Does this rally have legs? I mean, I missed the boat, last week, so I'll have to a little bit of regret there.
But you mentioned another name that's leading the Dow Jones Industrial Average higher this morning, and that is Amazon. So Amazon shares are up by nearly 2% in New York morning trade, and they had a very interesting announcement, didn't they, yesterday regarding work and employees? So
they essentially said that Andy Jassy, the CEO, came out and said, we're all going to 100% return to work. Now, there's a little asterisk. If you've been approved remotely previously, and there's little bits and bobs, but generally everybody back in the office. And that, I think the market likes that. I think people feel that you're more efficient in the office than you are working remote. Now, I would have to say that working remote, you do save all that commuting time, which sometimes actually goes into your work, and I certainly recall doing that. You essentially probably take at least half your commuting time and put it back into work. But Amazon's gotten pretty big. It has always had a reputation of not being the best place to work. That they're very aggressive. They push you really hard. So, and they've gotten sort of bloated. You hear about poor third-party merchants where there's one complaint or two complaints and then they can't sell anymore. So I think there is a little bit of bloat in middle management at Amazon, and this is an easy way of, I think, removing some of that. If you don't want to come back to work, great. Maybe we don't need that. So certainly Wall Street really likes it, and it's a trend where firms are trying to push people back as much as they can.
And I do have to say that when it comes to corporate culture, workplace culture, Amazon has been criticized for their competitive nature. But when we think about returning to work, so Amazon said employees must return to the office 5 days a week starting January 2025. But that does have implications for commercial real estate, doesn't it?
It does. It's going to matter in certainly in places like Seattle or in different cities where Amazon has a big presence. They would have had a big presence in New York, but some politicians got in the way. So you never want to turn away really, really great jobs in business. I'm just saying. But I think that's going to matter for those cities. Will it really move the needle? It's uncertain. I saw a stat today that said still offices are only 50% full. Well, you never know. From when I had to drive to the train parking lot today, and I practically got the last spot. So Mondays you're going to have a couple spots, Tuesdays, Wednesdays, and Thursdays are really full, and Friday is a ghost town. Friday there's 3 cars in line, for which I'm really grateful because then I could park really close to the entrance. So I think commercial real estate, this is a little bit of a band-aid, but I think they still have a lot of issues.
Well, I think we'll have to wait and see to see how this unfolds and what this means for the metropolitan cities across the country.
Yes.
So very quickly, Tai, I do want to look at the other markets in terms of market action this morning, looking at the U.S. currency as well as treasuries. So what do you think of what we're seeing in the FX market this morning?
So we're seeing, well, let's look at dollar yen first, because we always talk about the yen carry trade. And just, I think it was overnight, we briefly touched below 140, which we hadn't seen since July 2023. But today, as we watch now, it's 140, 170. Dollar yen is up a big figure, what we call a big figure, so 1 yen. I think we're seeing in all the markets a little bit of a correction in terms of where they were yesterday. People are arranging the deck chairs on the on the deck of the ship, ahead of the storm, so to speak. So you see that gold has backed off a little bit. Gold had a great run, historic highs. And the bond market, which has been really strong, you can see yields have backed up. The 2-year, the yield is up 6 basis points. The 10-year is up 2 basis points. We're seeing a little correction in lower in the base metals, while energy continues to go up. But overall, I think this is backing off a little bit of what the market was thinking in terms of 50 basis points. People thinking, what if it's not? We like it, but let's trim our sails a little bit. I think crude bears a special comment where it's been since the low in WTI, I think we're up probably $3.50 to $4. Now, that said, it's a good rally, but the rally still looks corrective to me. As I look at the chart, I would say WTI still has the sort of a downward bias unless we can break above, say, $73, and then in which case I think the price action goes sideways. But I think demand for crude reports out that it still isn't great and won't be great for the rest of the year. But I think this is a corrective move from a market that was very, very short.
And tomorrow is Wednesday, so we will be getting inventory data out tomorrow morning, and that does come before the rate announcement in the afternoon. It
comes at 10:30 Eastern time, and that's a really amazing number. So I've seen that number, and I sat next to the crude oil traders as a metals trader for over a decade, and that number can be just way out of left field. I've seen numbers where it's supposed to be plus 4 million barrels and it's flat or negative. So that can be a big mover, and gasoline as well for the crude oil market.
Absolutely. So we'll have to wait and see tomorrow morning where that number comes in. And since it is 10:30, we will be live to report on that tomorrow.
We'll get fresh, hot off the presses.
And before we go, let's take a quick look at Boeing this morning. I know that we wanted to weigh in on that before we wrap up for today. So what do you make of the price action we're seeing today, Tai?
So Boeing's up 1%, which is pretty good. The strike hasn't hurt them that much. I think we'll see what management comes up with in terms of a new proposal. But I think there's a little bit of armor in that they're only one of 2 major aircraft makers, and certainly they make planes for the U.S. as well. I mean, certainly it's not the money, the U.S. military, and it's not the money that you get from the commercial airliners. It's nowhere near the volume, but when push comes to shove, I think there's a floor under Boeing. The question is, where is that floor? and I think the floor is a little lower than we are at 157. Again, I'd like to see it down towards maybe the 130-ish region, where maybe I'll be smart and move or put an order in. Like I was thinking about Intel and I missed that train. So hopefully I won't miss this train.
Well, we don't have a crystal ball, and they do say hindsight is 20/20. So.
And predictions are hard, especially about the future.
Absolutely. Well, Tai, as always, it's been a pleasure. I look forward to speaking with you again tomorrow.
Great. Thank you.